The information discussed on Talkin Money with Jeff Tarbell is believed to be from reliable sources. However, no responsibility is assumed for inaccuracies. No statement made on this broadcast should be construed as a specific recommendation of a particular investment product. Views expressed are those of the speakers and do not necessarily represent those of CBS Radio. Use only as directed.
Smiles, everyone. Smiles. And prepare yourself for...
Show me the money!
Ladies and gentlemen, the radio broadcast experience designed to keep your wallet in top condition. It's Talkin Money with Jeff Tarbell.
Talkin Money. Talkin Money.
More money, more money, more money.
And now entering the studio, your guru for fiscal fitness, Jeff Tarbell.
Good morning. Are we on, Chris?
We're on.
All right. Good morning, everyone. This is Colin Grail in the studio, filling in for a vacationing Jeff Tarbell. I'm Colin Grail with Westlake Grail and Glover in Granite Bay, California. In the studio with me, I have Monica Reyes.
Good morning, everybody.
Good morning. I don't know how many of you are on Jeff Tarbell's Facebook page, but Jeff once again is taking a well-deserved vacation. He is, well, the last I saw, I think in Honduras. I saw a nice picture of him rounding the curve at the Cayman Islands, and as Jeff would say, we've got he had a very nice picture of a high-end bank of tequila and a couple of big margaritas sitting on the counter, so I know he's having a good time. This is a work conference. Thanks, Jeff. You got to wonder what your mortgage broker's doing in the Cayman Islands. Hopefully he's looking for some more money to bring back so he can lend it to everybody. I know next week he'll be on the air, back live after 2 weeks off. He'll be sharing his experience, as he always does when he gets back from a place he hasn't been to before. So he'll always have some good commentary. He'll always be wishing he could move there. And, I saw some pictures of some big boats that he'll wish he could buy, but will just remain a dream. So anyways, tune in next week. You're also going to be catching up on what's going on with HARP loans. Those were introduced last week. And, I'm sure Jeff will have some commentary on the latest of the B of A solution to the mortgage mess that's out there. They're going to be doing a test market on what's going on in the giving houses back and not kicking the people out, but renting the houses to them. So there's a big test that was announced with Bank of America this week. There, for people who are upside down, they'll take over the house, they'll take over the mortgage, they'll sign a lease and lease it back to them. They don't have to leave the house. So they're going to test that, see how that goes. All right. Again, I'm Colin Grail. With me is Monica Reyes. We are both certified financial planners with the private wealth advisory firm of Westlake Grail and Glover out in Granite Bay, and we're happy to be here. One of the things I just saw in this morning's paper, and I want to just point out, there's some things that just drive me crazy that hit the headlines. So I read this headline it was actually the Wall Street Journal. And here's the headline. Dow ends skid but has year's worst week. What does that mean? What does that mean to you, Monica?
I think
Oh. Mic 3. Okay, we're there we go.
All right.
There we go.
Here we go. I'm here, folks. So when I hear that, I think I know better. But when something ends a skid, makes me think it was on a landslide, a free fall. That seems pretty terrifying to folks that maybe don't know better, or maybe you're watching their accounts very closely. Is that true, Colin?
So that's what it says to me. So these are the headlines that just drive me crazy. So what are they trying to get us to think? And what they don't tell you is that the Dow Jones is up over 7% year to date. S&P is up over 11%. NASDAQ 100 is almost 20% increase year to date. and the international index is up 11% since January 1st. So I guess my message in this is be careful of the headlines that you read. Be careful what the point is. They're selling news. They're not selling financial advice. And they got to keep you coming back day in and day out. And so I don't know. I just thought that was interesting because I read that and think, God, we're having a pretty good year. And yet I read that headline, and it doesn't make me feel that way. So not that there aren't things to be worried about out there. There is a whole host of things to be worried about out there. But anyways, for whatever that's worth. Another thing I wanted to throw out there, there's been tons of talk about Apple. I don't know if everybody's excited or sick of hearing about Apple, but you can't get away from it. Whether you own one, whether you buy their stock, whether you're interested in just, I don't know. I was sitting there this morning as I was getting ready for the show, and I had 3 Apple devices up and running. My phone, my iPad, my iMac, so I guess I'm either part of the problem or the solution. I'm not sure. But here's what's going on with Apple. And I wanted to bring this up because this is a stock that I'm getting lots of questions on, but I think it represents similar questions that can go across any company. And and what Apple did is on Monday they announced that they were going to finally start paying dividends. They're going to pay $2.65 a quarter for Apple stock to Apple stockholders. That's about a 1.8% dividend. Steve Jobs was adamantly against paying dividends. He was just stockpiling cash in the company until they're just under $100 billion in cash. And as the saying goes, they've got more cash than the federal government does. So the question is, once you hit a certain point of cash, what do you do with it? So you have a couple options. You need a certain amount of money to run your company. You can go out and reinvest it to try to grow the company, or you can return it to the shareholders. And so what they had decided to do this Monday is to start paying a dividend. So the question becomes, is that good or bad for the stock? And the answer is not necessarily either. There's different schools of thought. Some people think that they love dividend stocks. They love getting that check in the mail or that check posted to their account. And they see that as a sign that the company is profitable. On the other hand, others will say, they couldn't figure out what to do with that money to grow their company, so they guess they're going to send it back to the shareholders. They're saying that we're out of investment opportunities. We don't know what to do with our cash, so let's just give it back to our shareholders. And when shareholders really, if the value of the company is rising, have the right to sell shares if they need some money or some income anytime they would like. So there's different schools of thought on that. In the grand scheme of things, it will open it up to a group of investors that would only buy dividend stocks, so that might get a broader market. But I think in and of itself, it doesn't necessarily make the stock of the price go up or down. The other thing they announced is they're going to do a buyback of shares. So we see this in the paper. What does buyback mean? They're going to go out in the marketplace, use some of their cash to actually buy back some of their shares. And the question is, why would they do that? The reason they stated they're going to do that is they're going to spend $10 billion of their $100 billion buying back shares. And what they said they don't want to do is dilute the stocks. So with their executives and employees, they have a stock incentive plan where they issue them shares of stock based on certain bonuses and things happening in the company. As they do that and they issue more shares of stock, in effect, that makes everybody's share value, there's more shares of stock out there, so everybody's share value actually goes down. So to offset that, they're going to go back and buy shares from the marketplace so that they don't dilute the stock. So I think that that's actually an okay use of that cash also. But again, in and of itself, all it's doing is trying to keep the stock price stable so that it doesn't get diluted. Part of the market was hoping for a stock split. I also get these questions. When a stock announces they're going to split, they say, does that mean I doubled my money if it splits 2 for 1? Or in this case, some people were hoping for a 10-to-1 split. And really that, again, doesn't, in and of itself, isn't good or bad. It doesn't change the value of the stock. All it does is simply create more shares at a lower price. And at the end of the same day, you have the exact same value of the company on the street. So what it can do is make it affordable and more attractive to a broader market when you lower the stock price. There's people that today will not pay $600 a share for Apple stock. but they may be willing to pay $60 a share if it split 10 to 1. So again, stock splits aren't good or bad. And so I just like to throw that out. These are questions I'm getting every day of, ooh, do you think Apple's going to split? Should we buy some before that happens? Or now that they've declared a dividend, what's that going to do to my stock? And so most of these are neutral to the stock price, and it's really an indication that they've got cash. They're running their business well. They've got the money they need to run their business, and they don't have enough opportunity to go out and invest that cash for growth.
Well, Colin, I've got a question for you. The three things that you mentioned there are actions that Apple could take. And we talked about stock price stability. Are these good or bad strategies? But I heard about something that's happening in the market that may affect Apple that may be a bit beyond their control. And so I just want to get your thoughts on this and maybe reach out to the listeners to say, Apple is part of an index called the NASDAQ 100. Now, the NASDAQ 100 represents 100 companies available in the market, mainly in the tech sector. Now, Apple's stock represents currently about 20.5% of the NASDAQ. What I've read is that there is some consideration to reduce that weighting, maybe down to 12 to 13%. Now, what that's going to mean for Apple as a company is that if they're held in, for example, an index fund, an investment that maybe benchmarks the NASDAQ, those types of indexes and benchmarks have to mirror the NASDAQ composition. So if NASDAQ is going to reduce the amount of Apple held, then that means that those benchmarks are also going to have to sell off shares in order to make that match. Now, when that happens, if there's not enough buyers out in the market, we're going to see tons of shares of Apple come into the marketplace. I think we can expect potentially some short-term volatility and in that stock price. So it's, when we see clients or folks that say, ooh, well, I've got this Apple shares, these Apple stocks, and I see the price jumping all around, is that something I need to be scared of, worried about? What are your thoughts on that?
Well, I think the market's going to start anticipating it now that it's announced, and it takes place, I believe, May 2nd? The indexes are going to be rebalancing, is what they call it, but they're going to be flooding the market with these shares. And so, what you can expect to see is just some volatility. They're going to put a bunch of shares out there. They need to be purchased, and you're going to see a lot of anticipation of what this will do and some shuffling, but it doesn't change what the company's doing in and of itself. Okay. These shares need to change hands. Will there be enough buyers temporarily at the price for the number of shares that need to be traded? We don't know. There's no way to know. They'll be managing that. They'll have there'll definitely be strategies and regulations of how to manage this type of a transition. But if you own Apple stock and you start seeing the price jump around a little bit here, I wouldn't see that as a concern for the company because there's just going to be a lot of shares trading hands over the next month or so. Okay.
And like you said earlier, this could be any of these four scenarios can be something that could happen with any stocks that the listeners out there own. So the lesson is, when you see a lot of movement in the market, when you see headlines that tell you that the Dow has skidded, really to look into that on a fundamental level and figure out, well, what caused it? Is there really a reason for alarm?
That's right. So, all right. So that's just a little bit of investment talk out there. After the break, we're going to come back and talk a little bit about an area of financial planning and retirement planning that we just can't talk enough about, and that's in the retirement area, just some concepts and things that people need to do. What we're going to do is have a quiz question. What are we going to give away? I think we're going to give away some Sierra Ranch ski passes.
Yeah, I think there's actually going to be snow after this weekend, so those will be useful.
All right.
Finally.
Need to get some people up there on the hill. So here's the question. As of the end of the first quarter approaches, with stocks showing gains, how did the Dow Jones Industrial Average do last year in the first quarter? And this is multiple choice to try to make it easy on you. How did the Dow Jones Industrial Average do first quarter of last year? A, down 12%, B, down 4%, C, down 2%, or D, up 6%. And then I throw in a E, who cares, which is really probably most people's answer. But there is a right answer to this. Down 12, down 4, down 2, or up 6. And give us a call. We'll give you some ski passes, and we'll be right back.